Hey there, Brian Bogner, along with the most amazing Gregory Towner. And we're going to be spending the next 5 minutes with you talking about the five charts that we think matter the most here in what's going on in the market. So without further delay, Greg, let's take it away.
Yeah, let's do that. Absolutely. Well, let's take a look here at the three-year chart of the S&P 500. And we'll notice once again, we are coming up on this resistance point, this downtrend line that we've drawn in red. The orange line is the 200-day moving average. We can see over and over the past year or so, we've gotten stuck at this key resistance point. And so, I mean, logically, we would think we're going to get stuck there again until proven otherwise. It's probably the way to think about it. However, there's some things occurring that we think could be the time it moves above. So for starters, right here, this chart is the Consumer Sentiment Index going all the way back to 1970. And historically, when this troughs at a low point, going forward the next 12 months or so, market returns are very, very strong, much higher than normal. And so we can see on the far right there, we had a low point not too long ago. In fact, if we were to go back, Brian, to our first chart, we could point out that the low points kind of in the fall period. Yeah, June through October period is when that sentiment index was at a low. So it's not too surprising, perhaps, in hindsight now that the market has rallied. We think that it potentially could, this might be the time that it breaks out because of the sentiment had gotten so negative.
Mm,
And also, if we had a low point in December that was higher than the October low. So we're starting
right.
to show some positivity from a technical perspective.
And you and I both know the market loves to do what nobody is expecting it to do.
Right,
Yeah.
exactly. And so why was consumer sentiment so negative, last fall? Well, inflation, of course, right? That aligns right where you're pointing there. That high point in inflation, not coincidentally, was the low point for consumer sentiment. People got really negative. Well, now, fortunately, in the last few months, we've been seeing the sentiment numbers come in, or excuse me, the inflation numbers come in. And we think there's room for that to continue in the next few months. Yeah, you see it down about 6.5%. That's year over year. We look at the monthly data, it's improving even more. And we think that it could improve in the months ahead. And the reason for that, or one of the reasons, is around shelter, as they call it for CPI, mostly rent. The black line is how the CPI, the government data, factors in that rent data. They're very slow to have it be reflected.
Right.
But if we're looking at what's going on in the real world a little bit, the blue line is a measure done by Zillow of rents. Seeing some real softening there. Now, it's hard to say, it could take a few months, maybe even longer for this to work its way into the CPI, but the rents and shelter are a huge percentage of CPI. So the way things are going now, both with that, some other data, we actually think the CPI, which is the last print was over 6%. We wouldn't be surprised if by springtime it's under 4%. It may not happen in a straight line. We may have one surprise month that shocks us a little bit, but we could get that back under four, and that would be a big relief to not only consumers but to all of us in the industry and the Fed that are watching all of that data. So most of that is good, really good, potentially, anyways. And this chart is mixed. I mean, this looks at the number of job openings out there compared to unemployed workers. We recently had a chart in our monthly viewpoint that showed how many more people over the last couple of years have retired than normal, which is not that many available workers out there. And this chart really shows that there's a lot of job openings. Now we're seeing more and more headlines about layoffs, particularly in tech. I think there's no question the job market is, on the margins, softening a little bit, but there's still a lot of people, or a lot of job openings per unemployed person. That's
Yeah.
great, except for what? The Fed. The Fed is concerned that if the job market remains incredibly strong like it has been, that's going to keep inflation high. So the Fed actually wants to soften the job market a little bit, counterintuitively to how most people would look at
Right.
things, right?
Right. Yeah. So, so in closing here, just like you said at the beginning, stocks are at resistance, but we've got a lot of negative sentiment, which is actually positive. So if we see that market break up that red line and get over, start making some new highs there, that is going to be very, very, very bullish for stocks. And just like you're talking about, Greg, with inflation moderating, it seems like the markets are discounting that. Stocks are discounting that. even longer term interest rates have come down. There's a lot of things that are discounting that, except the verbiage and the wording from the Fed that we keep hearing that they're going to be just keep raising rates to combat inflation. And that's really the real risk here, is that if the Fed continues to be super aggressive in raising rates, we keep talking about a soft landing, a hard landing, all these different landings, but that's what we're really watching right now. So is what are they going to do? Which, at least at this point, they've said they're just going to keep raising pretty hard, but hopefully that will change this next year. So if you have any questions, give us a call, shoot us an email. Thanks so much for watching. And as always, have a great day.